Welcome to the deep dive. Today, we're tackling a really interesting company, almost a paradox, really. We're looking at CompoSecure Inc. That's ticker CMPO.
Right. It's fascinating because they operate in two completely different worlds simultaneously.
Exactly. On one hand, they're the leader in a very, let's say, traditional space, those premium heavy metal payment cards you see.
The status symbols, very high-end, very physical.
But then they're also making this huge, almost futuristic bet on digital asset security. It's quite the mix.
It absolutely is. You have to think of it as a business with a split personality. You've got this established engine and then this much riskier growth venture bolted on.
So our mission today really is to dig into that. We're going to use a detailed investment analysis to understand this dual model, their big strategic moves, and crucially, the risks involved. We want to figure out if the high price tag the market puts on CMPO makes sense.
Yeah. Is that premium justified? Or is it masking something dangerous underneath? That's the core question.
Let's break down that split personality you mentioned. First, the core engine.
Okay, so this is the bread and butter. The mature, very profitable business designing and making those premium metal cards. They're the market leader here. It turns out cash.
The fortress, as you put it. Then the flip side.
That's the growth option. This is the new kid on the block, the Arculus platform for digital asset security. Think crypto wallets, digital ID. High growth potential, but, much less certain. It's basically a big bet, a call option on the whole digital asset economy taking off.
Might be huge, might be nothing.
Pretty much. And that sets up the central conflict for anyone looking at this stock. It trades way higher than its direct competitors, like, say, CPI Card Group.
A big premium.
A very big premium. And for that premium to be rational, you, the investor, have to get comfortable with an absolutely massive level of customer concentration risk sitting right at the heart of that profitable core engine.
Okay, that's the tightrope. Let's start walking it.
Mm-hmm.
All right, let's unpack that core engine first. The metal card business. For most people, I guess, a credit card is just functional. Plastic.
Right. But CompoSecure has managed to elevate it. Their product isn't just about making payments. It's engineered to be desirable. A status object.
So they're not just selling a payment tool, they're selling prestige.
Exactly. It's a status symbol. That's the whole pitch to the big banks, the global financial institutions, even the newer fintech players. The weight, the look, the feel, it's all designed to make that card the one someone wants to use first. The top-of-wallet card.
So the value for the bank isn't just the card itself, it's what the card does for them.
Precisely. It's a tool for customer acquisition, for keeping high-value customers happy, for building loyalty. If you give your affluent customers something exclusive they like showing off, they stick with you. They use your card more.
And CompoSecure has data on this, right? I remember seeing a pretty striking number.
Oh, yeah. It's compelling. They found that 72% of ultra-high net worth individuals report using their metal card more often than the other cards they have.
Wow, 72%.
Think about that from the bank's perspective. That's nearly 3/4 of your most profitable customer segment actively choosing your card, generating more fees, engaging more with your services. That high manufacturing cost suddenly looks like a pretty good investment for the bank.
That makes sense. And this desire for premium stuff, it feels like a solid trend, not just a fad.
It is. That consumer demand for premiumization is a real tailwind. But what's also interesting is how the disruptors are getting in on it. The neobanks, the fintechs.
Like Robinhood or Coinbase, you mean? They need a physical presence?
Absolutely. They start digital only, right?
Yeah.
But they often need something tangible to signal quality and value. A heavy, sleek metal card becomes a physical ambassador for their brand. It's like their version of a fancy flagship store on Fifth Avenue. It helps them stand out.
So this trend is pushing metal cards beyond just the traditional players like Amex or Chase.
Definitely. It's broadening the market significantly.
And this is where the growth potential gets really interesting, because even with all this, metal cards are still a tiny fraction of the overall market, aren't they?
Tiny. We're talking less than 1% of all payment cards shipped globally each year are metal. Less than 1%. The total payments market is enormous, trillions of dollars.
So if you're bullish on the core engine,
that sub 1% number is the bull case for long-term growth. It suggests a huge runway for penetration. If metal cards go from, say, under 1% to maybe 3%, 4%, 5% over the next decade, that's massive sustained growth for the market leader, CMPO.
Okay, but hold on. If it's that profitable, and we'll get into the specific margins later, I know they're high and the growth potential is that big, why hasn't everyone just jumped in and copied them? What's stopping bigger companies? What's the moat?
Well, the moat is real. It's built on like 2 decades of specialized experience, and it's protected by IP. This isn't simple metal stamping.
Right.
You're embedding chips, antenna, security features, bonding proprietary materials together in a very difficult form factor. It's complex manufacturing.
And they do it all in-house in New
Awesome.
Jersey, right? Not outsourced.
Exactly. It's highly controlled production in Somerset, New Jersey. They have proprietary manufacturing processes. They can handle complex designs at scale. And importantly, they have over 60 issued patents covering things like how materials are integrated, antenna tech, secure enclosures.
60 patents is a lot.
It is. Plus, you need certifications from Visa, MasterCard, Amex. You need long-standing trust relationships with these massive financial institutions. Banks are very conservative. They don't just swap out suppliers for something as critical as their premium cards on a whim. These are high barriers.
But let's push back a bit. You mentioned competitors earlier, big ones. IDEMIA, Thales Group. These aren't small shops. IDEMIA's got, what, nearly 3 billion euros in revenue? Thales is a giant conglomerate.
That's the flip side. That's the risk.
Can 60 patents and 20 years of experience really hold off companies with basically unlimited resources forever? Couldn't they just buy a competitor or throw billions at R&D to catch up?
And that is the core long-term question hanging over those juicy margins. The moat is strong, yes, because of the complexity and the trust factor. But IDEMIA, Thales, these are global powerhouses.
Right.
They can afford to bid aggressively on those big contracts, maybe even take a loss initially to win share. They can invest heavily to try and match or bypass CompoSecure's tech. So while CMPO leads today, keeping those high margins, it requires constant innovation, staying ahead technologically, and being incredibly efficient operationally, especially the market keeps growing and becomes even more attractive to these giants.
Okay, so the core engine. Profitable leader, big growth runway, but facing serious long-term pressure from huge competitors. Profitable, but maybe a bit precarious. So that profitable but precarious cash cow is generating a lot of money. How are they using that money to hedge their bets to reduce that reliance on the cards? That brings us to Arculus, the growth option.
Right. This is CompoSecure basically saying, hey, we're experts at making secure physical things like tamper-proof metal cards. Why can't we apply that expertise to the digital world?
Makes sense. Leverage what you know.
Exactly. So they decided to build a hardware crypto wallet, but using their core strength, the secure form factor.
And they stuck with the credit card shape, which seems smart. People get that.
Yeah, familiarity helps adoption. The main product is the Arculus cold storage wallet. The key here is security aimed at mainstream users, not just crypto geeks. They push the three-factor authentication hard.
Right, the 3 factors.
You need the physical Arculus card itself, you need your secret PIN, and you need a biometric approval, usually through an app on your phone. Tap the card to the phone, use your fingerprint or Face ID. It's designed to be much harder to compromise than just software wallets. Addresses a key fear holding people back from crypto.
And it's not just about storing crypto, is it? They seem to be thinking bigger about digital identity.
That's the next step. The Arculus Authenticate solution uses the same secure card platform for broader digital identity management. Think passwordless logins for websites, secure access to online services. The idea is the physical card becomes your unhackable key to your entire digital life. It fits right into where the world is going with needing better digital ID solutions.
Okay, let's talk strategy. I thought their B2B2C approach was interesting. They're not trying to go head-to-head with the big consumer crypto wallet names like Ledger or Trezor directly. Why that route?
Well, think about it. That direct-to-consumer hardware market, it's already pretty crowded. And winning there means spending a ton of money on marketing, building a brand from scratch. It's expensive and tough.
Okay.
So Arculus decided, why fight that battle? Instead, they're pursuing a partnership model. B2B2C means they partner with businesses that already have huge user bases, and Arculus provides the security layer for those users. They're essentially saying, we'll build the secure vaults for the existing castles, rather than trying to build our own castle from the ground up.
Smart. Less friction. So let's talk about those partnerships, because those are the proof points, right? That's what the market is looking at. The MetaMask deal seems huge.
It's potentially massive. MetaMask is arguably the biggest non-custodial crypto wallet out there. Millions of users. Partnering with them to create a self-custody payment card, basically. An Arculus card linked to your MetaMask wallet for spending crypto plugs Arculus directly into that giant ecosystem. It gives all those MetaMask users a secure physical way to actually use their crypto in the real world.
Okay, that's a big potential user base. And there's MoneyGram that connects Arculus to the traditional financial world, right?
Correct. This one's about liquidity. How do you get money into crypto easily? And just as importantly, how do you get it back out into cash? The MoneyGram integration, using the Scalar blockchain, lets Arculus users potentially go to a MoneyGram location and turn cash into crypto sent to their wallet, or turn crypto from their wallet back into cash. It bridges the gap between digital assets and the real-world economy. Huge for usability.
On-ramps and off-ramps, as they say.
Exactly. And finally, the N-Exchange partnership adds another piece.
Which is?
Crypto swapping. So, within the Arculus ecosystem, users can securely swap one type of crypto for another. N-Exchange provides the plumbing for that, finding good prices. So now, you can potentially store Arculus, spend, MetaMask Link, get cash, MoneyGram, and swap assets and exchange, all secured by the Arculus card. It makes it a much more complete platform.
These partnerships really paint a picture of building an ecosystem, and this progress is showing up in the numbers, right? Arculus hit a key milestone recently.
Yes, huge step in Q1 2025. The segment reached positive net contribution,
Meaning?
meaning the direct revenue Arculus generated finally covered its direct operating costs. It's not making a huge profit yet, maybe, but it stopped being just a cost center. It's starting to pay its own way.
Yeah.
That's a critical signal to investors that the model can work. It's the first step towards real profitability for the venture.
And the market they're playing in, the hardware wallet space, is expected to grow pretty fast.
Oh yeah, the projections are strong. We're talking potentially double-digit growth rates, CAGR, for years. Some estimates see it going from around, say, $450 million in 2024 to maybe close to $1.9 billion by 2032. It's a rapidly expanding pie.
So if Arculus can grab even a decent slice of that pie through these partnerships,
It could become very valuable very quickly. It helps explain why the market might be willing to pay that premium for CMPO stock compared to peers who don't have this kind of high-growth digital option.
Okay, let me play devil's advocate again, though. CPI Group, their main public comp, they do partnerships, too. Is the Arculus B2B2C model really that different, beyond just the cool card form factor? And isn't that hardware wallet market getting crowded anyway? Can they really gain traction?
That's a fair point. The differentiation, I think, has to be more than just partnerships. It's which partners and what problem they solve. First, the security itself. CompoSecure's deep expertise in secure manufacturing. That's hard for software-first companies to just replicate. That physical security layer is a real technical edge. Second, look at the utility the partnerships enable. MetaMask for spending, MoneyGram for cash access. They're targeting ease of use and real-world applicability, which are often weak points for wallets like Ledger or Trezor that are more focused purely on storage for crypto experts.
So making it easier for the average person, not just the hardcore crypto user.
That seems to be the goal. But you're right, execution is everything. If these big partnerships don't actually translate into significant user adoption and transaction volume, then that embedded value the market sees in Arculus could evaporate pretty quickly. The potential is there, but the risk is real too. Okay, now we have to pivot. We've talked about the strengths, the potential. Now we need to stare directly at the biggest weakness, the elephant in the room. This isn't a minor issue, it's the defining vulnerability for CompoSecure.
Customer concentration. Let's get right to the numbers. This is the stat that really makes you pause.
It really does. The analysis showed that in 2023, just two customers, American Express and JP Morgan Chase together, accounted for 70.5% of CompoSecure's total revenue.
70.5% from two companies.
Let that sink in. More than two-thirds of their entire business relies on the decisions of just two clients.
I mean, that's putting almost all your eggs in just two baskets. And these are powerful baskets that can decide to go elsewhere.
Exactly. Think about the implications. If either Amex or JPMC decides to change their premium card strategy, maybe they cut back, maybe they decide to bring production in-house, or maybe a competitor like IDEMIA or Thales swoops in with an unbeatable offer.
The impact wouldn't just be bad, it would be devastating.
Catastrophic is probably the right word. Losing a customer responsible for, say, 30 or 40% of your revenue overnight, that fundamentally cripples the company because it's an existential risk.
And it must give those two clients enormous power in negotiations, right?
Immense bargaining power. It means CompoSecure's ability to raise prices or dictate terms is severely limited. Even if they have the best product, the ever-present threat that one of these giants could walk away forces them to be, well, very accommodating. It puts a cap on margins, potentially.
So everything else we discuss, Arculus, the M&A strategy we'll get to, it all has to be seen in this light. These aren't just nice-to-have growth projects.
They are strategic imperatives. They are direct, necessary efforts to diversify the business away from this crippling dependency. Management knows this is their Achilles heel. They're essentially racing against time to build other revenue streams before something happens with one of those key accounts.
So anyone investing in CMPO needs to understand that the current valuation, that premium, fundamentally assumes they succeed in this race.
Absolutely. You are betting that they can mitigate this concentration risk before it blows up.
Okay, beyond that two-client risk, which is huge, there's the margin pressure we touched on earlier.
Yeah.
Those gross margins, like the 57.5% in Q2 2025, they're really high, almost too good to be true.
They're fantastic margins, but they act like a giant flashing sign saying, come compete with us, to those big players.
Idemia and Thales again.
Right. They don't need 57% margins on this one product line to make their numbers. They're diversified giants. They can afford to be much more aggressive on pricing to win those big Amex or JPMC contracts. Trying to defend nearly 60% margins against that kind of firepower long term, that's going to be a constant battle. It requires flawless execution and continued innovation.
And then there's the technology risk, the cards themselves. We love the feel of the metal card, but isn't the long-term trend moving away from physical cards altogether?
That's the other shadow hanging over the core engine. The rise of mobile payments, Apple Pay, Google Pay, digital wallets, could eventually make the physical card less essential. If your phone becomes your primary secure way to pay and prove your identity, does the physical card become just a backup, a novelty item? If that shift accelerates, it could slowly erode the core business, even if they keep their current clients. Arculus, of course, is their attempt to play in that new digital identity world, hedging that very risk.
It's like they're trying to build a lifeboat while sailing the potentially sinking ship.
That's one way to look at it. And one more risk factor. Simple economics. Premium products tend to be cyclical.
Meaning if the economy tanks,
Financial institutions cut back on discretionary spending, marketing budgets get slashed, big expensive new card rollouts get postponed, demand for premium, status symbol cards would likely drop sharply in a recession.
so it's sensitive to the economy.
Yes, and that adds another layer of vulnerability. Imagine a recession hits and one of the big clients decides it's time to renegotiate terms aggressively. That's a potential double whammy hitting revenue and margins simultaneously. #tag IV, financial performance and accounting complexity.
Okay, so we have these significant structural risks. But despite that, if you look at the recent numbers, the core engine has actually been performing incredibly well operationally.
Yes, the execution, particularly on efficiency, has been impressive. Revenue growth picked up, hitting 7.7% in 2024, reaching over $420 million. But 2025 really showed a step change, especially that second quarter.
Q2 2025 was a standout. Non-GAAP net sales were up a solid 10% year over year to about $119.6 million. But the profitability metric, pro forma adjusted EBITDA, jumped 26% to $46.3 million.
That difference, 26% EBITDA growth on 10% sales growth, that's powerful operating leverage.
Yeah.
It signals they're getting much more profit out of each dollar of sales.
Yeah. And the driver was margin expansion.
Big time. Gross margin expanded by almost 600 basis points, 588 to be exact, hitting that 57.5% level. That's not just volume, that's getting fundamentally more efficient.
And they credited this to something called the CompoSecure operating system, or COS. Can you unpack that a bit? What is COS actually doing?
Think of COS as their internal program for continuous improvement in manufacturing. In a complex process like making these metal cards, it means finding efficiencies everywhere. Maybe it's better sourcing of the metals and components, reducing material costs. Maybe it's optimizing the proprietary machinery, getting more cards per hour with less waste. Perhaps better quality control, reducing rework.
So squeezing out costs and improving throughput.
Exactly. These aren't just one-off savings. They aim to be structural improvements baked into how they operate. And achieving that kind of gain is crucial if they want to defend those margins against the Idemias and Thaleses of the world.
And the strong performance led them to raise their guidance for the full year 2025.
Yes, that strong Q2 gave them the confidence to bump up the full-year targets, looking for around $455 million in sales and $158 million in adjusted EBITDA. The market definitely likes to see that kind of beat-and-raise dynamic.
But you have to be careful looking quarter to quarter, right? The revenue can be lumpy.
Very lumpy. That same Q2 showed it perfectly. Domestic sales shot up 22%, but international sales actually fell 35%.
Wow, that's a big swing.
It highlights how dependent the timing of their revenue is on when those big clients decide to launch or refresh major card programs in specific regions. You can't expect smooth, predictable growth every single quarter. You really need to look at it on a trailing 12-month basis to get a clearer picture.
Okay, let's shift to the balance sheet and cash flow. They make a lot of cash.
A ton of cash.
Wow.
Free cash flow was nearly $85 million in 2024, up a huge 62% from the year before, and they've been smart with it.
How so? Paying down debt.
Primarily, yes. They aggressively pay down debt, cutting net debt by 60% in 2024. As of Q2 2025, their net leverage, that's net debt divided by adjusted EBITDA, was down to a very comfortable 0.66x. That gives them a lot of financial flexibility to invest in Arculus, pursue M&A, and weather any storms.
Okay, strong cash flow, low debt. But this is where the accounting gets a bit confusing for the average person. If they're so profitable, why did their official GAAP net income show a big loss, like $83 million in 2024?
Ah, yes. This is a classic example of why GAAP net income can sometimes be misleading, especially for companies that went public via SPAC, like CompoSecure did.
Okay, what's going on there?
That reported loss was driven almost entirely by non-cash accounting charges related to warrants and earnout shares issued during the SPAC deal. It's called a mark-to-market adjustment.
Mark-to-market, meaning?
Basically, as the company's stock price goes up, the potential future liability associated with those warrants and earnouts also goes up on paper. Accounting rules require them to record that increase in liability as a non-cash loss in the current period, even though no actual cash has changed hands.
So it's an accounting loss triggered by the stock actually doing well.
Ironically, yes, in this specific context. It makes the bottom line look terrible, but it doesn't reflect the actual cash-generating power of the underlying business. That's why focusing on adjusted EBITDA and free cash flow gives you a much truer picture of their operational health.
Got it. Non-cash charges messing with the GAAP number. But the accounting fund doesn't stop there, does it? There was a big restructuring with the Resolute spinoff in early 2025 that changes how you even read their statements now.
This is really important for anyone analyzing them going forward. In February 2025, they spun off Resolute Holdings. Now, the parent company, CompoSecure Inc., CMPO, accounts for its main operating subsidiary, the part that actually makes the cards and runs Arculus, using something called the equity method.
Equity method versus consolidation. What's the difference for us?
Before the spinoff, CMPO owned 100% and consolidated. That means every dollar of revenue, every dollar of cost from the operating business flowed directly onto CMPO's main income statement. You saw all the detail.
Okay.
Now, with the equity method, it's like the operating business is in a separate box. CMPO just reports its share of the profit from that box as a single line item on its own GAAP income statement. It doesn't report the underlying $455 million in sales or the detailed expenses anymore on its main GAAP financials.
So if you just look at the main CMPO GAAP revenue number after February 2025, it's going to look way smaller and won't tell you much about the actual business operations.
Exactly. To understand the real size, the growth, the margins of the actual card and Arculus business, you have to look at the non-GAAP and pro forma numbers that management provides. The headline GAAP numbers become almost useless for tracking operational performance after that spinoff. #V, strategic direction and capital allocation.
Okay, that restructuring, the spinoff of Resolute Holdings, leads us straight into their current strategy. And frankly, this is where things get a bit unusual from a governance perspective.
It is a unique setup. Resolute Holdings Management, or RHLD, was created. It's led by the same key executives, the executive chairman and CEO of CompoSecure, but it acts as a legally separate external manager focused purely on M&A.
An external manager run by the internal executives to do M&A for the company they already run.
You see the potential complexity. The stated goal for Resolute is clear. Find and execute acquisitions. These could be smaller bolt-on deals to add capabilities or potentially larger transformative acquisitions, the main driver. Accelerate growth, yes, but critically. Diversify the business away from that Amex JPMC concentration risk.
Okay, the goal makes sense. Diversification is crucial. But why set it up this way? Why pay an external entity run by your own execs to do M&A when the core company is throwing off $85 million a year in free cash and has hardly any debt? Couldn't they just build an internal M&A team?
That is the multi-million-dollar question, literally, because this structure isn't free. It creates a permanent financial drag on the operating business.
How so? What's the cost?
The operating subsidiary has to pay Resolute Holdings a quarterly management fee. And that fee is calculated as 2.5% of the operating subsidiary's adjusted EBITDA over the last 12 months.
2.5% of EBITDA, just for managing M&A.
Yes. Based on the Q1 2025 numbers, That fee was already running at about $3.2 million per quarter. Annualized, you're talking somewhere north of $12 million a year, potentially growing as EBITDA grows,
Yeah.
being paid out to this external management entity.
Wow. That's a significant chunk of change just for the M&A function.
It is, and it creates what's known as a principal agent problem. The agents that the managers running Resolute get paid a hefty fee based on the core business's profitability, regardless of whether the acquisitions they choose are actually successful or add value for the shareholders of CMPO, the principals.
So there's a potential incentive for Resolute to do deals, maybe even suboptimal deals, just to justify its existence and its fee.
That's the risk investors have to watch closely. Is this structure truly the best way to deploy capital for CMPO shareholders? Or does it mainly benefit the managers through Resolute? It introduces an unnecessary layer of execution, risk, and cost, in my opinion. They need to diversify, yes, but paying a permanent 2.5% EBITDA tax for it, that's a structural flaw investors need to factor in.
Okay, so a controversial M&A structure. But despite that cost, management has also started returning capital directly to shareholders, which usually signals some confidence.
Yes, that's the other side of the capital allocation story. They've explicitly broadened their philosophy beyond just reinvesting everything. They boosted their share repurchase authorization up to $100 million.
Buybacks. Tax-efficient way to return cash often suggests management thinks the stock is cheap.
Exactly. And perhaps more significantly, they initiated a dividend. They paid their first ever special cash dividend of $0.30 per share in early 2024.
So dividends are now officially part of the toolkit.
It seems so. It signals they recognize the core engine is mature and profitable enough to support shareholder returns alongside the investments in Arculus and the M&A strategy. It's about balancing growth bets with rewarding the investors who are sticking with them through these risks.
And just quickly on governance, it's a controlled company, right? One entity holds most of the voting power.
Yes, Tungsten 2024 LLC controls just over 50.5% of the votes. That means public shareholders have limited say in big decisions, which is typical for controlled companies. It provides stability but concentrates power.
But management's interests seem aligned with shareholders otherwise.
The alignment looks pretty strong on paper. Insider ownership overall is very high, around 56.6%. And executive pay is heavily tilted towards performance. In 2023, something like 90% of the CEO's target compensation was variable, tied to performance metrics. So their personal financial success is directly linked to making the company perform well long-term, including navigating that diversification challenge. That's a positive counterweight to the controlled structure. #tag Vigas. Valuation and investor synthesis.
All right, let's try to pull all these threads together now and look at the valuation. Where does CMPO actually trade, given everything we've discussed, based on that 2025 guidance they raised?
Right. If they hit those numbers, you're looking at valuation multiples around, let's see, roughly 4.6 times enterprise value to sales and about 13.3 times enterprise value to EBITDA.
Okay, 13.3x EBITDA. How does that stack up against their main competitor, CPI Card Group?
That's where the premium really stands out. CPI Card Group trades at significantly lower multiples, roughly 7.3 times EBITDA, based on recent numbers.
So CompoSecure is trading at almost double the earnings multiple of its closest public peer.
Pretty much. That's a very substantial premium the market is awarding CMPO.
So the big question is why? Why is the market willing to pay almost twice as much for each dollar of CompoSecure's earnings, especially given that huge 70.5% customer concentration risk we keep coming back to?
There are two main arguments the market uses to justify that premium. The first one is pure quality of earnings, the margins.
Right. CMPO's margins are much higher.
Dramatically higher. CompoSecure's adjusted EBITDA margins are up around 36%. CPIs are closer to like 14%.
Sure.
So the argument is you pay a higher multiple because each dollar of CMPO's revenue generates significantly more profit and cash flow. It's just a more efficient, more profitable business at its core.
Okay, higher quality core business justifies a higher multiple. What's the second reason?
The second reason is the embedded optionality. It's the Arculus factor.
The growth option.
Exactly. The market is clearly assigning real, tangible value to the potential of Arculus becoming a significant player in that fast-growing digital asset security space. CPI Card Group simply doesn't have anything comparable. They don't have that speculative but potentially explosive growth lever. That call option on the digital future helps bridge the valuation gap.
But let's push on that. Arculus just barely reached positive net contribution. It's still very early days. Does it really warrant that much embedded value in the stock price today? especially when weighed against the very real, very quantifiable risk of losing Amex or JPMC. It feels like a big leap of faith.
It absolutely is a leap of faith. The current valuation assumes near-perfect execution on the diversification strategy. It assumes Arculus continues to grow, that those partnerships deliver, and that the M&A strategy under Resolute successfully acquires good assets that meaningfully reduce the concentration risk without overpaying.
And if any of those assumptions prove wrong,
Then that valuation premium is very vulnerable. If Arculus stalls, or if the M&A doesn't deliver diversification quickly enough, you could see the market re-rate CMPOs much closer to CPIs. And that would imply significant downside for the stock price. It's priced for success, not for bumps in the road.
okay, let's synthesize. Time for the final showdown. Bull versus bear. If you're making the bull case for CMPO, what are your key arguments?
The bull case is built on quality and potential. You've got the clear market leader in a premium, high-growth niche metal cards. It's protected by proprietary tech, those 60-plus patents, and real manufacturing expertise demonstrated by the COS efficiency gains. This engine throws off tons of cash, the balance sheet is strong with low debt, and crucially, they have a defined strategy to address the big risk. Arculus is gaining traction with major partners like MetaMask and MoneyGram, showing validation. Plus, you have an experienced management team whose pay is tied to making it all work.
Strong core, validated growth option, aligned management. Okay, now the bear case. What keeps the skeptics worried?
The bear case is dominated by one word: fragility. The overwhelming risk is that 70.5% customer concentration. It overshadows everything. Then you layer on the persistent threat of margin compression from huge global competitors like IDEMIA and Thales chipping away at those high margins. Add the long-term existential risk that mobile payments eventually make fancy physical cards obsolete. And finally, sprinkle in the specific execution risk and the questionable governance optics of that external Resolute M&A structure and its permanent 2.5% EBITDA fee.
So it really boils down to a high-stakes balancing act.
It's the ultimate risk-reward trade-off. Are those superior margins and the exciting but speculative upside from Arculus enough compensation for taking on the truly enormous structural risk embedded in that customer concentration? That's the question every investor has to answer for themselves. #outro.
So let's quickly wrap up this deep dive. CompoSecure presents this fascinating picture, a highly profitable cash-generating machine in its core metal card business.
But one that lives under the constant shadow of extreme customer concentration.
Right, and they're actively and quite expensively trying to escape that shadow through two main avenues. Their nascent digital security platform, Arculus, and this new, somewhat controversial M&A strategy managed by Resolute Holdings.
And through it all, the company's underlying strength really comes from its internal capabilities, its proprietary manufacturing tech, its patents, and maybe most importantly, the deep, trusted relationships it's built over decades with some of the biggest financial players in the world. Those intangible assets are key.
Which brings us to our final provocative thought for you, our listener, to chew on. Given that CompoSecure's durable competitive advantage seems rooted in its internal expertise, the technology, the processes, the trust built from within, does the strategic choice to outsource the critical function of diversification M&A to a separate external entity, Resolute Holdings, and to pay that entity a permanent fee based on EBITDA? Does that truly represent the best possible use of the company's significant free cash flow to protect and grow its core value proposition and technological moat over the long run?
Or could that capital and that strategic function have been deployed more effectively internally? That decision about governance, structure, and capital efficiency might just be the most critical factor determining where CompoSecure goes from here. Something to think about.